Welcome to the Four Seasons Podcast, brought to you by B&H Wealth Strategies, serving Northeast Tennessee and Southwest Virginia since 1966. Here, we guide you through the ever-changing seasons of your financial journey, offering insights to help you grow, protect, and enjoy your wealth. Ready to turn your financial dreams into reality? Dare to dream. And now, here's your host, President of B&H Wealth Strategies, Jeff Bingham.
Season might be over, but smart financial strategy isn't a once-a-year event. The best time to plan for next year's taxes is now. So how can you get ahead and keep more of your hard-earned money in 2025? Welcome back, everybody. Skip Monty here, co-host / producer, back in the studio with B&H Wealth Strategies President, Mr. Jeff Bingham. Jeff, how you doing today?
I'm good, Skip. How about yourself?
I'm doing great. Now that we're past April the 15th, I'm doing a little bit better, although it was a little painful for me. But now that we're
everybody's favorite time.
Oh yeah, that's all right. Well, now that we're past that, how do we get ahead of the tax game in 2025?
Well, that's one of my favorite topics to talk about, is taxes. And it's obviously something that is right now top of mind. And as my dad used to always say, it's not about how much you make, it's how much you get to keep. So what do we do? And, people always want to have great tax reduction strategies. And my dad used to always tell people, well, one way to do it is make less income. That's generally not something that people are interested in. So we try to find alternatives to that as we try to find the solutions that are there. And there aren't as many things out there today as there used to be when I talk about the history of the firm. And when we go back, from 1966 forward, and so there was a period of time when tax rates were very, very high, and there were a lot of alternative, limited partnerships and purely tax strategies in the 80s and whatnot that were out there. So we've evolved from that, coming forward. But that was part of what this firm was about, even back in those days, was when tax rates were, as high as, go back in the 80s, probably as high as 70%, something like that, and then Dan Rostenkowski and Ronald Reagan struck a deal and, cut tax rates to give or take, kind of where they are today. I mean, there's been some changes, but it's not a lot of differences. I mean, there's some, but people might want to, pick at what I just said right there. But we've kind of stayed in this range rate from where we are from, again, when President Kennedy in the 60s, tax rates were as high as 90%, in the upper income tiers. I mean, think about that.
Wow.
Now, again, there were so many loopholes and there were so many things, that were there. So the tax code itself is 2,672 pages in volume. That's how many pages there are in the IRS tax code, with a corresponding maybe 70,000 pages of supplements and addendums and resources that go along with that. I mean, I think if you look at that, that's like 35 million. I heard this today. It's like 35 million words, I think. And that'd be like reading the Bible like 50 times or something crazy like that. So anyway, that's our tax code. It's ridiculously complex, and it's just one of these things where we just stack things on top of it, right? We don't ever get rid of anything. We just kind of stack on top of it. Most people just kind of throw their hands up in the air out there and just are like, I don't know. And what do you do about it? Right. Anyway, with all that being said, what can we do? And like I said, I don't prepare taxes. I'm not a CPA, nor do I want to be. So what I try to do with my clients, and now with the listening audience out there, is to try to have them do all the things that they can do, right, within their legal limits to reduce their taxes before they take it to their CPA or before they plug it into their TurboTax to do it. Because basically when you start doing your income tax or you take it to your CPA, they're just scorekeepers, right? You're going to give them the docs, they're going to plug it in, and then they're going to spit it back out, and they're going to say you're either going to get this much back or you owe this much. Here's your total tax liability for the year, and here's your bill. So that's kind of how the world that most people operate in. So what we look at is how can we reduce that so when you do take it to light the scoreboard up, that you can have less tax and more of your own money kept, right? Because I think it's fair to say that most people out there will believe that you can do better with your own money than the government can do with your money. I think that's a fair statement to make, and I think most people would agree with
Amen,
that.
brother.
But we also want to be you got to be careful. I mean, the difference between tax avoidance and tax evasion is about 20 years. So again, with that kind of setting the table right there, then you just begin to look at what are you doing currently? What might you do otherwise? I mean, simple things like if you're working and you've got an employer sponsored retirement plan, are you putting as much money into that employer sponsored retirement plan that you can, right? Because the money that you put in there is a deductible contribution, right?
Right.
So if you make $50,000 or whatever number it is, whatever the number is, doesn't matter. If you put, whatever dollar you put into that, you reduce that taxable income, that salary that you have, that wage that you have. Every dollar that goes in there reduces that. You still have to pay Social Security tax on it, but you take that out of the income tax calculation. So you have a deductible contribution that goes in there. Right. So first, that's what you want to do. That's a way to reduce tax, right? So if you got $50,000, you put $5,000, 10% of your income into that 401k plan. Your taxable income now is $45,000. If you're in a 20%, again, just using easy math, if your effective tax rate is 20%, you just reduce your taxable or your tax liability by $1,000 by doing that. So, that's one simple way to do it. It's also an effective way to do it because you get the money into the retirement plan. It's going to grow on a tax deferred or tax free basis. Now, on the flip side of that, when it comes out of that retirement plan, every dollar that comes out of it is taxable. So you got to be sensitive to the drawdown on those monies as well. But that's one way to do it. So let me stop there and see if you want to kind of dig in around that a little bit, Skip.
Well, I was actually going to ask, you mentioned 401k, but what other tax advantage accounts should individuals or families prioritize contributing to before year end?
Well, I think so. You got your 401k plan if you got an employer sponsored plan. Now, there's some income limits and some various things that I'll go through, but you could also complement that with an IRA, right? You could have your own individual retirement account, which you can, if you're under age 50, you can put in $7,000. If you're over age 50, you can put in $8,000. You have what's known as a catch up provision. So you can do that. And that's both husband and wife can do that. So you have, if you're over 50, that's $16,000 a year you can contribute into an individual retirement account. Those are deductible dollars if you're using it and you fall within the right income ranges. There's, like I said, don't that's not a blanket statement that is absolutely true because you've got an employer sponsored plan, you make X number of dollars. There can be some limits on what I just said right there. So that's not, those are the caveats to that statement right there. A lot of times people want to, and I'm not saying that you shouldn't, so do not misunderstand this at all. So a lot of people want to pay off, mortgages really quickly and get them over and done with. And a lot of times that's a really good idea. But if you have an extremely low rate, like a lot of people that, before 2022, when you think about people that got mortgage rates at 3%. So my question would be, why would you ever pay that off early? Right now, you might be able to, but in that lane right there, when you think about it like that, using other people's money, using the bank's money at 3%, like we just use that 3 or 4% when you can, and that's deductible, right? And that's deductible. So if you're in a 20% tax bracket and you're in a 3.5%, you just reduce your taxable in. I mean, that's like 2.7%. Because of the deductible interest on that. So can you earn more than that on your money? In today's world, in the bank, at interest rates, we'll call it 4%, right? The leverage is on your side. So why would you pay that off? Like you might be able to, but it's, sometimes it's more effective to use other people's money, even though you might be able to pay it off or pay it down and do those kind of things. So, I want to be careful when I say those kind of things because I'm not suggesting that debt is good. But we always say, well, debt is bad. And most of the time, that's a blanket statement that should be held to. Like debt is borrowing. When you have debt, you're borrowing from your future, right? That's what you're doing.
Right.
But with, mortgages, like we're talking about right here, and interest rates at that level, and you can make more money than that just on risk-free money, right? I mean, that's a risk-free money. I'm not talking about, borrowing from your house and going out and investing in Bitcoin like we've talked about in other episodes. That's not what I'm saying. So don't nobody out there think that that's what I'm suggesting at all, because I don't think that that's a good idea in most or maybe all cases. But if you can earn, 4% on your money and the cost of that money is 3%, and you can deduct that interest, yep, then that's pretty good leverage. Right? That's leverage in your favor. That's using other people's money for your benefit, not because you have to, right?
Right.
That's a smart, prudent financial decision right there. And so that's one way to do it. The other thing is, what about the earnings that you've got? Like when you're investing your after tax monies that are out there, money that you're not using for income, but that you're paying income tax on, right? For a long time, people had money in the bank and interest rates were so low, they didn't have to worry about earning any interest. It wasn't creating tax liability. You could have a considerable amount of money in the bank and interest rates were so low, you didn't even have to file your 1099 on it. Well, now the interest rates at 4% or so, just using that as an easy number, what you're seeing with money in the bank, that it's coming over onto that tax return. It's creating more tax liability for you. So that 4% rate of return, where we're talking about it in a mortgage where it's deductible, well, in an earnings perspective of money you're not spending, you're paying tax on that. So it's diluting the rate of return and inflation. So we think, again, what I always say out there is that people see it at 4%, on an earnings rate. Well, they think, well, safe money and making money. What they don't realize, there maybe not be any market risk in that kind of earnings, but there is purchasing power risk. So 4%, if you will, take a 20% effective tax rate, takes that down to 3.2. And if you think inflation is 3.2% or around 3%, basically at best you're breaking even with your purchasing power. Does that make sense? So that's what
Right.
the purchasing power, that dollar, maybe it's kept pace for on a year over year basis on an after tax basis. But in most cases, I would say it's not, because I think inflation, the real rate of inflation is not in that 3-ish% number that the headline number is that's out there, because again, we exclude energy, we exclude food, and we exclude healthcare. Now, how many of you all out there listening don't spend money on those things? Everybody spends money on those things. As a matter of fact, a lot of people spend more money on those things than they do any other things that are out there. And yet we exclude those from the CPI number as it's reported out there. So it's an interesting thing that we do, because it's too volatile, they say, to include it in there. Okay, that's a different. I won't go into that rabbit hole. But so inflation, so in other words, your purchasing power with that type of money, it's creating tax liability, and you're actually, even though we feel better about higher rates of return in the bank right now, it's like, oh, we finally earned some money in the bank, which is true. But is it really more? Are you making any more money on it from a true purchasing power perspective than it was when interest rates were low and inflation was running less than 2%? Again, taking all the facts that I talked about around that. So, it may be closer to kind of the same effect, right, of what the purchasing power of the earnings on that money is, if you will. But what we look for is, can we defer, right? There are tax deferred vehicles that are out there that you can utilize, that can be safe, and they can have some growth components where, if you can earn 4% on a tax deferred basis versus 4% on a taxable basis, you definitely have improved your rate of return, right? So you're closer to, I'm not having to pay taxes. I'm also keeping up with purchasing power risk that I think is something that most people don't think of. But it's the silent risk that people are taking with their money, is that purchasing power risk that's out there.
Interesting. And so I guess the inverse of, if you've got a high interest rate on your mortgage, it would be beneficial to pay it off early.
Absolutely no. And again, using my data, without question, right? When you think about it, if you've got your 6 or 7%, and you've got, now again, you got to think of liquidity issues and all that. But let's say you owe $100,000 on your mortgage, right? You're down to that. You've whittled it down. So it's $100,000, and it's a 6%. It's at 6%, and you have $100,000 earning 4% in the bank, right?
Right.
What should you do? Right. Well, at least without taking anything else into account, you'd pay that debt off. Right. I'm earning 4, it's costing you 6. Like that's a 2% swing on it, right? I
Right.
mean, that's, without doing all the tax calculations, you lose your liquidity. There's some things that need to be taken into account. So don't nobody run out there and do, act on what I just said right here, from watching the pod. But that's certainly where you want to begin to have that conversation. That's leverage. That's not leverage in your favor at all. That's the kind of debt you want to get rid of
Well,
for most
well, I
definitely.
feel very fortunate to be on the opposite end of that spectrum. So thank you for, because I've always heard that if you could make an extra house payment once a year, twice a year, it would be beneficial to pay it off, but apparently not in my case.
Well, and again, I'm very careful around these topics like this. So it's not like, oh, he told me, I saw the financial advisor guy on the podcast say, absolutely don't pay the mortgages. I'm going to do. That's not what I'm saying. Everybody's situation is different. Everybody's comfort zone is different, so you really have to take that. That's a measurement of a lot of things. But if you just are looking at it from a financial perspective, right? Just math, just the pure math of that says, if I can earn 4 on my money and the debt is costing me 3, why would I pay it off? Right.
Right.
And so from a mathematical perspective, absolutely.
Great.
Then as that number goes up, you start having other conversations about it.
Well, every situation is different. So that's why people need to call B&H Wealth Strategies so that it can help them out there.
Yeah, would love to have conversations about this and any other things that folks want to talk about. We're always available to be a sounding board and hopefully to give you sound advice as well.
Awesome. Well, Jeff, it's been a great episode. I have learned a tremendous amount, and maybe we could talk more about tax is a deep subject, so maybe we can touch on that again in another episode.
Absolutely.
All right.
Anytime.
All right. Jeff, have a great rest of the day. Thanks so much.
You too, Skip. Talk to you soon. God bless.
You too.
Thanks for tuning into the Four Seasons podcast, brought to you by B&H Wealth Strategies, where your financial success is our priority. Schedule your free 20-minute consultation today by calling 423-247-1152 or by visiting bhretire.com. Take the first step toward making your financial dreams come true. Until next time, remember, every season is the right season to plan for your future. Securities and registered investment advisory services offered through Silver Oak Securities, Inc., member FINRA SIPC. B&H Wealth Strategies and Silver Oak Securities, Inc. are not affiliated.